Ladies and gentlemen, good day and welcome to Godawari Power and Ispat Limited conference call. Please stay connected. The call will begin shortly. Participants, you have been connected to Godawari Power and Ispat Limited conference call. Please stay connected. The call will begin shortly. Thank you. Ladies and gentlemen, good day and welcome to Godawari Power and Ispat Limited Q1 FY23 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen only and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sana Kapoor from Go India Advisors. Thank you, and over to you, Ms. Kapoor.
Thank you, Neerav. Good morning, everybody, and welcome to Godawari Power and Ispat Limited earnings call to discuss the Q1 and FY23 results. We have on the call Mr. Abhishek Agarwal, Executive Director, Mr. Siddharth Agarwal, Executive Director, Mr. Sanjay Bothra, CFO, and Mr. Dinesh Gandhi, Executive Director. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. May I now request Mr. Dinesh Gandhi to take us through the company's business outlook and financial highlights, subsequent to which we will open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Sana, and good morning, everyone. I welcome you all to this conference call of Godawari Power and Ispat Limited to discuss the Q1 FY23 results and the way forward. I'm sure that you must have looked at the earnings results and the presentation uploaded on the stock exchanges and the company website. I will briefly discuss the results and then we can have the Q&A and some other developments taken place during the quarter. We had a good start, of the financial year 2023. Then I will discuss the quarterly performance in detail. And before that, there are few different developments and strategic initiatives which the company is taking. I'm just updating on that. As committed in last call, GPIL is constantly working towards simplification of group structure, and we have already increased our stake in HFL from 75.6% to 91.82%. We have also acquired 78.96% stake in the Hira Ferroalloys. We have acquired the Jagdamba power plant through a some sale route during the quarter. And the Jagdamba 25 megawatt power plant asset has become the asset of the Godawari Power and Ispat, and Godawari is running that unit from the date of acquisition, that is 7th June 2022. This entire power of 20 megawatt, 25 megawatt will be consumed captively in-house. Simultaneously with acquisition of 25 megawatt power plant under some sale route, we have tendered the 26% shares GPIL was holding in Jagdamba for the purpose of qualifying for the captive user were no more required. So we have surrendered under the buyback scheme launched by the company. As regards the capex, we have already announced that capex which are ongoing and close to 500 crore of capex is planned in the current financial year, out of which we have done 150 crore in the first quarter. Despite imposition of duty and other developments in the marketplace, we are committed to commission this capex of 500 crore during the current financial year, which mainly includes setting up of 155 megawatt of solar power. Out of that, 70 megawatt power plant has already been almost commissioned. It is just awaiting the synchronization of the grid. and remaining capacities for some part of the land acquisition is still pending. And once that is done, we will start the construction process, and we are quite hopeful that within FY23 we will be able to complete the entire 155 megawatt solar capex. And this entire power will be consumed, will be for the captive requirement, which will be mainly replacing the grid power. Due to some strategic reasons, there are changes in certain business plans, and therefore we have kept the expansion of the steel billet project from 0.4 million to 6 million ton on hold. We are working on a revised scheme, and as and when that is finalized, that time this expansion of capacity will be taken up in due course and will be updated to the investors accordingly. As you are all aware, we are also focusing on reducing the carbon footprint that I already discussed. 3 projects with a total capacity of 155 megawatt. This 155 megawatt capacity plus 42 megawatt of waste heat recovery plus 8.5 megawatt of biomass power plant in Hirapero and 1.5 megawatt of windmill. With all this commission, our existing capacities, we will have achieved the carbon neutrality so far as the existing plant is concerned. As regards the update on the greenfield power project, we had announced certain plan for expansion of the capacity at the greenfield project. We are still in the evaluation process and finalize the design, size, capacity, technology, etc. And this investment will be taken up in due course of time once all these processes are completed, including environmental approval and land acquisition. And the exact investment will be announced. That will be purely based on the evolving market conditions and the future cash flow of the company. We will further keep you updated on this. I would like to mention that to cope up with the export duty on pellet, we have increased the sale of sponge iron, steel billet, MS round, HB wire, ferroalloys. The company has a competitive advantage as it produces high-grade pellet, and we are confident of achieving the targeted volume for the current year. Coming to the operational performance, Q1 FY, I am happy to share that GPIL has achieved the record high quarterly numbers for iron ore mining, iron ore pellet production, sponge iron production, all of them up 36, 11 and 12% respectively on YOY basis, 13%, 9% and 100% respectively on the QOQ basis. The sale of iron ore pellet, sponge iron, steel billet, MS rounds were up during the quarter by 6%, 835%, 29% and 22%, whereas sale of HB wire has reduced to 51%. As regards the HB wire, as you may be aware, during the last financial year, we were not making substantial quantity of HB wire because we were mainly exporting the wire rods in the international market. With the imposition of export duty, now logical process is to convert the wire rod into wire partially to the extent of capacity available and then sell it in the market. And gradually the HB wire utilization rate will increase going forward. Ferroalloy volumes in all the 3 plants, that is GPIL, HFL, Alok have shown increasing trend during the quarter-on-quarter basis. This new acquisition has definitely added to the profitability as well as the sales turnover of the company. On a quarter-on-quarter basis, you might have noticed the drop of 19% in sale of iron ore pellet. This drop is because of increased captive use of pellet for sponge iron. Last quarter, the sponge iron production was very low and therefore pellet sale was higher. Now we have converted pellet into sponge iron and sold, and therefore the drop in the 19% in the sale of iron ore pellet. Realization of pellet sponge iron have dropped slightly by 3 and 1% quarter-on-quarter basis. This is mainly because of fall in the market rate after imposition of export duty. Realization of other products like steel billet, MS round, HB wire, and other increased sequentially by 12, 13 and 17% respectively. The current prices of the long product and the current prices for the HR, the trade product now coming closer. The gap was substantially higher during the last financial year. Now gradually, the prices are coming in line with the long product price. Of course, there is some amount of gap will continue to be there in the market. The total expenses increased during the quarter, which is mainly attributable to the increase in the coal cost. We are required to import the coal for the sponge plant at a substantially higher price, and this is and to some extent on the inflationary pressure on the procurement of the other raw material and consumption items. The consolidated EBITDA is 461 crore, which is up 16% quarter on quarter and down 20% year on year. The reason for drop on YOY basis is increase in the cost of transportation of fuel, the increase in the royalty, and as well, both these items have resulted into higher cost of production. The consolidated PAT adjusted for exceptional item is up 5% sequentially and 327 crores. As you already know, GPR balance sheet is now fully repaired and debt has been fully repaid, long-term debt. We continue to have some working capital limit. Barring utilization of certain limits, we have a net cash position of 560 crores as on 31st of, as of now. Now, coming on the market position, starting with the international market outlook first. The iron ore prices from $158 ton on 1st April, the iron ore prices have fallen to $100 as recession worries to take hold. Demand and consumption of steel and other commodities is reduced to China due to COVID and real estate crisis in China, and in the rest of world interest rate hike. Expectations is that H2 FY23 things will improve due to China's stimulus and the support from economic growth. However, uncertainty remains due to the zero COVID policy by China. In regards to iron ore, while has already announced cut down in the production guidance, Russia and Ukraine iron ore supplies are already reduced, and with this, the iron ore prices, in our opinion, is likely to range between $100 to $120 during the current financial year. Coming on to domestic market, as you are all aware, government levied export duty on iron ore from 0%, iron ore fines from 0% to 30%, and iron ore lump 30% to 50%. In pellet, there was no from 0 to 45%, and the finished steel, the export duty is levied to 15% in May 2002. This has led to sharp drop in the domestic iron ore prices. NMDC has also cut the iron ore prices by approximately 2,000 rupees a ton. Pellet prices decreased from an average of 12 to 14,000 rupees a ton in April to 7,775. Presently, the pellet prices are ruling at about 8,800. The domestic iron ore prices are likely to bottom out at a much higher level than the historical level. The support has come from the cost curve, which has moved up by 1,000 to 1,500 rupees post auction of iron ore mines. The current iron ore prices, domestic mines have become, at the current iron ore prices, many domestic iron ore mines have become unviable. Some support has also come from the improvement in the domestic demand of steel and due to which increased take-off of infra projects. Going forward, improvement in the iron ore and the pellet prices will depend on the impact of the export duties. However, downside is largely projected at the current volume level and the selling prices. With this, I will open the floor for the question answer. Thank you very much.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Kunal from Reliance Securities. Please go ahead.
Good morning, sir. Congratulations on a good set of numbers considering the current environment. Sir, just some questions. Firstly, what will be the quantum of exports of pellets in 1Q FY23?
1Q FY23. I think, Botraji, you know how many consignments have gone in Q1 FY23?
I'll give an update on that. So on the export side, in Q1 we did about 3 shipments.
Okay. So that would be
150,000.
Okay, got it. And who's bearing the export duty?
The seller.
Sorry?
We have to bear if we happen to export now, then we have to bear the export duty.
Okay. So, I mean, what would be, how much export duty would have been borne in 1Q FY20? I mean...
Nothing. So, by the time the duty was imposed, so we only had one shipment which was pending, and with the long-term relationship we have with the buyer, so that contract was amicably cancelled. So we didn't export after the duty was imposed.
And so, going forward, what's your guidance on exports for FY23 overall?
Till the time if the duty is not revoked, we don't think so we will be able to export a single ton also. So we will focus totally on domestic market till time the duty is not revoked. Where these prices, it's totally unviable to export after paying 45% duty.
Okay, got it. So, my second question is, what's your overall pellet sales guidance for the current year?
See, we are operating the plant at almost 100% capacity. So with a DRI consumption of about, say, 0.75 million tons, rest will be totally domestic sales. So the sale guidance will be around about 1.75 million tons in this financial year.
Oh, sorry,
1.75.
Okay, got it. So then one more question I had. Our captive iron ore costs have been increasing actually. I mean, it's increased substantially from, say, 2,800 in FY22 to 3,150 in the current quarter. And if you see the trend has been, overall, it's been on a rising trend. So could you just throw some light on this?
Primarily, there are two reasons for the cost of iron ore to go up. One is on account of diesel. As you are aware, the diesel prices because of crude has been, hovering at the all-time highest level, which is about 100 rupees. So that has increased the cost on account of mining operations as well as on account of transportation from mines to plant. And second is substantial is royalty. So as you're aware, we are supposed to pay royalty basis the IBM published rates. So, and IBM rates are lagging by 3 months. For example, right now we're paying royalty basis the IBM price of May, and we're sitting in August. So as the prices will start coming down, the royalty portion will start going down. So on account of royalty and diesel, the cost has gone up almost 450 rupees compared to previous quarters.
Okay. Understood.
Yeah.
Okay.
Yeah.
So, okay. Then just one more question, if I could squeeze in. What would be the current realization of pellets and sponge iron?
Current realization, pellets at the moment, pellets are hovering about 9,000 rupees domestic level, and sponge prices are about 34,500.
Okay. So sponge iron prices haven't corrected that much, is it? My right understanding?
No. So just to give you a graph. So before duty was imposed, the prices were about 35,000. It came down to 30,000 rupees. And then again, because of extreme coal shortage at India level and with the global domestic prices being on very high side, the sponge prices have again come back from 30,000 to around 34,000.
Okay.
Yeah.
Right. Okay.
Because the thermal coal cost is not going down. The index is still about $300.
So actually, my next question was on that only. I mean, we are buying the prime quality coal, prices of which are continuing to remain very, very high. So how do we plan to tackle that? I mean,
so we do realize that in these markets it's difficult to procure prime quality thermal coal. So we have shifted, we have changed our charge mix, and now we are trying to import good quality cheap cargo. So now from RB1 we switch back to RB3 levels now. So going forward we should be buying RB3 coal, which is basically a 4800 levels NCV coal.
Okay. But I thought that our DRI unit could not take anything other than RB1 input.
No. That's not the case. The DRI plants are designed such that they can absorb any coal. Depending on the quality of coal, your production keeps varying. So with usage of RB3, there might be certain drop in production, about 2 to 5%. But technically, there's no issue to run RB3 because now RB1 is totally unable to procure with the current prices globally.
Okay. Okay. Got it. Okay. Thank you, sir. Thank you.
Kunal, I want to add one more point on this. I want to add one more point, on the coal.
Yeah.
We have been bidding for the other coal mines also. So, in order to protect the long-term requirements of the company and regarding the price fluctuation, we are bidding for the coal mines. As and when we are successful in that at a reasonable cost, after that, the dependency on the other market will reduce.
Okay. So, could you please throw some more light on this, because this is quite an interesting point that we are planning to acquire the captive coal mines. So under the auction by Government of India. Okay. So at what stage are we?
We have been meeting, sometimes we have not been so successful, so we try for in the next round. So that's how it is happening. So far, we have been unsuccessful because of the cost structure. We will continue to monitor the situation, and as and when we are able to get the cost, the coal cost, or the premium within our range band, I think we should be able to acquire a coal mine which will feed all the requirement of GPIL and Hira ferroalloys and Alok ferroalloys, because they are also dependent on the linkages from Coal India.
Okay. Got it.
Yes.
Okay. Thank you, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Hello, sir. Congratulations on good set of numbers in spite of tough situation that the company is.
Can I request you to speak a little louder, please?
Yeah, sure. Am I audible now? Hello?
Yeah.
Yes.
Yeah. So, sir, in case of your iron ore pellets, since it is our product is a high grade pellet, do we have a better realization than what the domestic price is? Just wanted to know.
Just to give you throw some light on this. See, definitely we do get a premium over and above the domestic market, but at the moment what is happening is since we were totally into exports and rather we were doing a little bit of domestic as well. Now I am scouting for new buyers who can realize the actual value of the product. So at the moment we are getting about 1,000 rupees more compared to the domestic market, and going forward, once we are able to establish our quality at different plants, I am confident we will get better premium going forward.
Okay, fine. And you have given, sir, around guidance of, as per your investor presentation, around 2.4 million ton for iron ore pellets. And we have managed around 6 lakhs, if I'm not wrong, in current quarter. So the guidance continues, right? We'll be able to...
100%, definitely.
Okay. Fair enough. Just one last question. The 70 megawatt, the plant in Ranjangaon will be commissioning in this quarter only, the 70 megawatt?
Yes. So the plant, the project has been completed. We're just waiting for the permission to be given by the state government for connection to the grid. Once that is received, we will commission the plant. So I'm hoping this should happen this quarter. Rather, this should happen this month only.
Okay, and that 70 megawatt is going to replace your grid power, right? Immediately.
Yes. So whatever volume you're importing from the grid on account of power, that will be replaced totally with the solar power.
Okay. Thank you. I'll get back in line. Thank you.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Sagar, individual investor. Please go ahead.
Morning, sir. So the question out there is, if I could see, we have increased our realizations in almost all of the products from Q4, if you say, in this quarter. So going ahead, how do you think we'll be managing this, means regarding the commodity price, etc.? Where will we be? Will we be able to stay above the current realization levels and margin levels, or will we see a softening in that? And if I consider a 2 or 3 year period, okay, where do we see Godawari going at or growing at? Some light if you could throw on it.
So on the first side, when it comes to realization, it's difficult to ascertain because, we're sitting in a commodity market, and at the moment, everything plays with demand and supply, right? So it's difficult to ascertain how prices will, unfold going forward. So at least on the revenue side, we don't have a control. But yeah, in terms of cost margins, we are working very minutely on each and every cost, and we are hopeful that we should be able to maintain the current margins.
Okay, that's good.
Yeah.
And so
Demand is going up in domestic market. Sorry to interrupt. And you have seen, despite imposition of export duty, at least the impact of export duty is much higher on the plate product. But so far as long product is concerned, you have seen that after imposition of export duty, the long product prices have slightly has been better than the Q4 FY22 versus Q1 FY23. So we have realized higher prices on sponge iron, steel billets, even for that matter HB wire we have started production. So you have to see it in two parts. One, the iron ore will definitely not be able to export it, although it may get dumped unless the government gives some relief on the export duty. And lump ore requirement will continue to be there in the domestic, because whatever fines which were exporting, to that extent there is an impact. Pellet we were exporting because the realizations were much better or at par with the domestic market, and in order to balance the domestic market. Now, even despite the export duty, we are still able to sell the pellet at about 8,000 to 9,000 rupees a ton, and that is a handsome price. And we believe that because of, as I said in my opening remarks, the international iron ore prices are likely to hover between 100 to 120, $25. And if that remains, then the pellet prices, in my opinion, may not go down below 8,000 rupees a ton. Temporarily it can go, but on an average, realization on a medium to longer term basis, I think 8,000 to 9,000 rupees is a benchmark where the prices should, trade in the market in a normal circumstances. And we will see, major impact of this after the monsoon.
Okay, got it. So regarding your view, where do we see in next 2 or 3 years?
In terms of what?
In terms of, you could say, growth, by how many percentage could we basically grow?
Growth in volume, we have been trying, and that is there. Whatever capex which we have done on deep, recently 500 crore road, it is more aimed toward the cost reduction rather than the increase in the volumes. Except steel billet, everywhere it is the cost reduction. Like solar power plant, we are that will be reducing our cost rather than adding on the volume of the cells. Beneficiation plant at the mine. So earlier we were mining say 1.8 million ton. Now we are aiming at 1.2 million ton. So the margins are going to, the turnover may not increase substantially. It will depend on the selling price of the product. But cost side, on the cost side, there will be a substantial reduction in the cost going forward, which will lead, iron ore mine and the solar power plant will aid to the bottom line of the company. So that is how you have to look it for next 1 to 2 years. And so far as greenfield is concerned, we are still working on the greenfield expansion project. I am not able to do any guidance at this point of time because number one, we have to freeze the technology. We have not yet been able to get the government land despite continuous possible. And with the revised scenario now, imposition of export duty, My cash flow is definitely going to be lower than what we had done in FY22. So all these factors will depend, and based on that, we are going to announce the final capex at the greenfield. And greenfield capex, then it is going to take 2-3 years time. So some top line growth may be there, but for next 2-3 years, I am not expecting any substantial top line growth in Godawari Power, except whatever acquisitions which we have done in Hira Ferroalloys and Alok. To the extent it will aid.
Okay, got it. Sir, just to add on what you said, when we are looking at cost reduction, let's say from the power plants, okay, the 150 megawatt that we may commission, say 70 now and 70 by the end of the year, if I assume. So after, let's say in FY24, okay, what is the cost reductions that we'll be getting just from this power? So we invested 500 crores odd for the 150 megawatt power plant. So what are we going to save every year based on this investment?
See, grid power cost, including interest and depreciation, may not go beyond 2.25. Whereas the grid prices are 6 rupees plus. At our mines where we plan to utilize 25 megawatt of solar power, there the rate is 14 rupees per unit. So, you are replacing 6 to 7 rupees per unit in the steel plant, and at mines you will be replacing the power with solar power, and that is we are buying at about 14 rupees per unit. So definitely it is going to aid to the operating EBITDA of the company going forward, and by reduction in the cost. Then we are investing out of this all 500 crore. We are investing about 70 to 80 crore for replacement of old turbine, so that we can have the higher generation, without setting up the other facilities. Only changing turbine with the latest turbine will increase our power generation by 10 megawatt. So my thermal cost, coal cost will also go down. Thermal power cost will also go down. And for growth, we are working because at existing location of our plant, whatever we could have done, I think with this 500 crore of investment, we have achieved what we wanted to achieve so far. And growth will come from the greenfield project or increasing the selling price.
Thank you. I request to all the participants, please restrict to 3 questions per participant. If time permits, please come back in the question queue for a follow-up question. Sagar, do you have any follow-up question?
Sure. So if I may add, just a last one. So we increased our stake in the subsidiaries currently. So any plan to make it a wholly owned, so increasing it to 100%, buying the residual? Any plans for doing it in the current year?
Whether it will happen in current year, it will happen in next year. At some point of time, it will happen.
Oh, that will be all. Thank you, sir.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Ashish Kumar from Infinity Alternatives. Please go ahead.
Hi, sir. Congratulations on a good set of numbers. The question which I had was in relation to your capital allocation. After a long time, we are seeing a net cash balance sheet, and we continue to generate cash significantly more than the capex. Obviously, there's a room to leverage up a little bit more as and when the capex programs are finalized. So, are you thinking of a large distribution back to the shareholders, given the bonanza of the last couple of years?
No, and
of a dividend or a buyback.
So far as I understand, we have rewarded investors in last 2 years substantially by way of distribution of dividend. And dividend, we'll be distributing about 115 crore once the AGM is over. So distribution will continue to be there, but then we have to look at the growth as well, the cost reduction, improving profitability. So if I'm using, and whatever this capex money which I'm using, is primarily coming from my divestment of stake in the solar thermal power plants which we divested in the last quarter.
Absolutely. No, I was hinting more towards a buyback.
Depending upon let me complete. Depending upon the cash flow of the company and the near-term plan or at least medium-term plan, will drive our dividend distribution or maybe other, mechanism for rewarding the investors through buyback or any other arrangement.
Sure, sir. And sir, in terms of
in fact, I'll tell you frankly, we're planning for the buyback, but with the imposition of export duty, now we want to be very conservative and keep the cash in hand rather than going out of the cash.
Sure. No, I understand fully.
Yeah, market. One simple government order can change the head of the industry.
That fully understand. But in terms of the immediate short to medium term, what I heard on the call was that the prices seem to have stabilized. And what would be the current EBITDA run rate based on the new based on where the prices have stabilized?
Frankly, we have not worked on that number, but we have guided you the pricing. What is the current pricing? Now 5 to 10% here and there, the prices are going to range in between till the export duty is withdrawn. Whether export duty will be withdrawn, it will be reduced. We really don't have any answer on that question. So based on that, and the selling prices are there, cost restrictions are there. You can work it out how much EBITDA we can generate from Q2 onwards.
Sure.
Q1 was exceptional because we had passed 2 months in export and our realization of pellet was much higher.
Right.
So the pellet realizations will now definitely in the current quarter will be lower than what we have done in Q1.
Right.
All other products are likely to remain where I think we have done in Q1.
Right. And in terms of the going forward, what's your expectation in terms of the export duty? Any color that you can share on that?
See, I'm not an expert on the sector. Large players are there. What I understand is, there is a surplus pellet about 20-25 million ton in India. Steel also India started almost 20-25%. Some demand growth will come. There is a surplus. Steel is available in domestic market. If what production versus the domestic supply. Similarly, iron ore. Iron ore will also is higher than what is required in the current year. So at some point of time, the export duty should get relaxed. And to what extent it may get relaxed, it depends upon the government. And I'm sure, looking at the data and, the sensible call will be taken by the government in due course of time.
Right. Okay. Thanks and wish you all the best, sir.
Thank you.
Thank you. Next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, good morning and thanks for a good set of numbers. Two questions, sir.
Sachin, sorry to interrupt you. Your voice is not clear. Can I request you to speak through the handset? Is it better now?
Yeah, please.
Yeah. First question, there was a mention that we are getting 1,000 rupees premium. So this is on this 8,800 rupees or 8,800 rupees the realization that you have indicated including the premium we are getting?
No, so see the prices when the duty was imposed had gone down to about 7,500 levels, 7,500. So that time we were getting about 8,500 levels. And now with the current market being stabilized, we are confident we will get 1,000 over and above the current levels of 8,500 levels.
Sure.
Yeah.
Secondly, the government, that's what the government is saying. One is to contain inflation. Secondly, they want more evaluation to happen. So hypothetically assuming that, for some little longer time the duty remains, what is the company must also have an alternate plan B, right? One is that the government sees some, rationality behind this and reduces the rate on the export duty. But for example, for whatever it is not reduced, what is the alternate plan B for the company from say a 2-3 year perspective?
Pellet being one of the major drivers, so we don't find any challenges because of a premium quality. We have established domestic market, and we have also added new clients on the list, big clients. So on the pellet side, we don't see any issue selling the product. Even the import duty is not revoked, the export duty is not revoked. We are totally okay with that.
Yeah, because I'm asking is in the presentation we have mentioned about some quite aggressive plans in terms of increasing both the pellet as well as the mining production next 3-4 years. So in case the duty is not removed, we think that we'll be in a position to sell this much in the domestic market over the next 3 to 4 years.
No, so see, the mining, whatever data, whatever, forward guidance they provided, that is basis the new greenfield project. So that will happen parallelly to the greenfield project. So the pellet guidance is given basis because if we happen to go for the greenfield project, they will be installing a pellet plant there as well for our in-house consumption. So for that, the mining capacity has to go up. At the moment, we have no plans of installing another pellet plant only for merchant sale. We have no plans of doing that at the moment right now.
So fair to assume that this 1.7 to 2 million ton is what we think in the next 1-2 years, what at best we can sell in the domestic market.
So our current capacity is 2.4 million tons, out of which about 30%, 35% is consumed for our DRI production, and rest will be sold in the merchant market. And that will continue to do so going forward as well.
Sure. Next question was on this capex, and you mentioned that this is looking at 500 crores capex. Currently, we are on cash of 500 crores. So, are we looking to calibrate the next 2-3 years in the sense will continue to remain debt free or net cash, or is it that if we have to do a greenfield, it will be okay to again go into some sort of a debt? If you could give your thoughts on that.
That will depend upon the size of the greenfield project which will be finally announced, with the requirement of funds and the what is my generation at that point of time, the cash flow generation from the business. So that will depend, and if required, we may not be able to take small debt from the market. It is not that we cannot raise the debt. We can definitely raise the debt, but we would like to keep the debt either at very substantially lower level and or otherwise manage everything within the internal accrual.
Sure. So can you give us some sense, on this leverage and the debt and IRR? So what is the minimum IRR we would look on a conservative basis before we go and do a large capex? And secondly, when you say maybe
simple theory, our payback period should be 3 to 4 years.
Okay. So unless we get that confidence, we are not going to do any large capex.
Exactly, yes.
And secondly, you mentioned about taking some debt.
That also I'm talking over a longer period of time. Shorter in interim, it can happen. In some year margin can go down, margin can go up in some years. But on an average, 3 to 4 years should be the payback period.
Sure. And what type of absolute or debt to EBITDA will be comfortable going up to for this project if need be?
Certainly, we have not thought about it much in much detail about it.
I'm not talking for the project, but I think as a corporate now, because we had a lot of stress 5 years back, and we have been talking of being very, very conservative. So I'm just saying, not specific in general, if you have to any large capex, what type of debt are you okay? Like 500 crores, 1,000 crores, or like one-time debt to EBITDA? What is the number where you mentally?
That is what I'm telling you. We will decide the size of the debt as and when we have the size of the project and the cost required is ready. So it's not that we are averse to taking debt. We will take the debt, and we have taken the debt and grown the balance sheet. At least in from 200-300 crore size of balance sheet in 2006 when we came out with the IPO. Today we have I think our size of balance sheet has already gone down in terms of 4,000 to 5,000 crores. So it's not that and we have taken the debt a number of times. So we are not averse to take that debt, but yes, we wanted to keep the debt at a very low level. So in any kind of situation, the company should be able to survive. Like
sure.
We have 2,000 episode we have always been conservative in terms of our investment. But I had taken up 1,500 crore of investment in 2011, and after that, due to change in the government guidelines, due to fall in the international prices of commodities, we came to a stage where we were able to earn only interest payments.
Sure. And just one last question.
So we will continue to be conservative in our approach, but definitely if required, we'll take some debt. And I'll tell you recently also, we have taken some debt, indirect debt, like we have taken the 3 years buyer's credit facility for our import of solar module. Rest we are importing it, you doing it through internal accrual.
Sure. Just one last question. This was also a query by another participant on this buyback, sir. So see, I understand that we have to be conservative and all that. But the type of cost structure we have and the type of sustainable EBITDA we can make even at depressed prices and the type of correction we have seen in the stock prices, I think it would also make immense sense if the company could look to allocate, if not large, a small sum to Bhart's buyback. But I think that may also be probably one of the best opportunity to deploy your cash at a point of time when, there's so much volatility in the steel market and we're not getting much clarity, spending say 100-200 crores on a buyback, I think will obviously send a good message to investors. May also be good investment for them.
No. I understand your point. And as I said, we were working on that plan, although we had not announced it. And because of sudden, imposition of export duty, you have to wait and see at least for 5 to 6 months to see where the market goes and stabilize. And at that point of time, if I go and open the buyback and use the money there, and if I need the money for operations, so we took a call that we will not do the buyback at this point of time. We'll wait for a suitable opportunity and do that.
Sure. Okay. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Yogesh Jaswani from Mittal Analytics. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I have a question on the beneficiation part that we have announced. So if you could share a bit more details in terms of the economics of this project that we are taking up. For example, what would be the beneficiation cost per ton? And in terms of the increase in production that we have mentioned, how much of that could be because of the beneficiation and not actual increase in mining?
Abhishek?
No, so see, I'll take it up. See, at the Godawari complex, we have already achieved a rate capacity of 3.28 million tons of beneficiation. The new beneficiation plant is coming up in mines because the main reason is to reduce our incoming cost from the mines. Because right now, whatever we get from mines, we are benefiting in Godawari facility, in which about 20% of wastage is generated, which are no use to us. So we are basically losing 20% on account of freight. So today the freight is about say 1,000 rupees. So 20% cost is going up on account of freight. So to save that cost, we have taken a decision to install a beneficiation plant in the mines area only. So that will substantially reduce the cost. That is the reason. And the project is already underway for 0.6 million tons. And the first phase should be completed by end of this financial year.
Understood. So one part of it I understood that instead of beneficiating at the plant, you'll be doing it directly at the mine, so that will save you some cost. But in terms of beneficiation cost, what would that be per ton?
It's very minimal, I'll tell you. So the beneficiation cost will be around about 150 rupees only per ton of iron ore. That's it.
Okay. And this will increase our the grade also, or it will just be able to utilize our wastage better?
No, this will only help us in getting the wastage better.
Okay. No efficiency in terms of the grade.
No, because we are already able to produce what we desire to. This is just a cost-effective measure to reduce our cost of iron ore.
Got it.
And I'll tell you one more thing. The another reason for doing it is, earlier we decided to, beneficiate at the plant area. The reason was there was issue in terms of royalty which has to be paid to the government of India basis the current structure. But now IBM has come with a different gate called concentrate. So moment you beneficiate iron ore, it is, it jumps to the category of concentrate. So with that they have started publishing the royalty for concentrates now. So it becomes much easier for us to, analyze the total value and pay the royalty. And this modification has come into place last 3 months only.
Okay.
The royalty is a big impact because currently the royalty of 55 compared to a 65 iron ore, the difference is almost about 800 rupees a ton, which is substantial going forward. So that is another reason. Now that has been clarified by Indian Bureau of Mines.
Got it. That's really helpful. So second, just one more clarity on the greenfield project that we are taking up. So here, are we sure that we want to take up another similar kind of setup with sponge, billet, and bars, or are we also
No. The greenfield project will be a primary route will be blast furnace based. We are not expanding into the current structure of sponge, billet, and all those things. We want to make good quality steel. So the greenfield project will be based on the blast furnace route.
Got it. Thank you.
Yeah.
Thank you. Next question is from the line of Tarang Agarwal from Old Bridge Capital. Please go ahead.
Hello, sir. Good morning, and thank you for your time. Couple of questions from my side. One, given the incidence of export duty, one would have imagined that, the realizations would take a material impact, but that hasn't really played out. And I mean, to an earlier comment where, it was indicated that we're already sitting at about 20 to 25 million tons of pellet surplus. So just wanted to understand how things played out on the ground and why we haven't seen the impact. Would we probably see the impact? It doesn't seem like we'll see the impact in Q2 also in terms of whatever external data that is available. So just wanted to get a sense how things really played out in the market. That's one. And then I'll follow it up.
See, I would like to, correct what you just said, because the prices before the duty was imposed was hovering about, 9,500 in Odisha and about, 10,500 in Raichur sector. So from 9,500 rupees, the prices had already gone down to 6,000 rupees ex-plant Odisha and about 7,500 ex-plant Raichur. The only reason, the only thing which played in our favor was the monsoon. With the onset of monsoon, sponge guys prefer to, use pellet over lump. And the production also of mines drastically goes down, at India level, whether it's NNDC or, OMC, being the biggest miners in India at the moment. So availability of lumps has gone down. Plus, during monsoons, most of them prefer using pellets over lumps. So that is why the demand is coming into the market. When the monsoon gets over, we need to see where the market will stabilize. It might go down, it might stay here. A lot of factors deciding it. So we have to wait and watch.
Okay, and given that there is a certain cost base to iron ore...
And just update you. So, June data of pellets, at India level, the production was down 20% compared to May month. So you can already see reduced production at India level when it comes to pellet. So June was 20% lower than compared to May. Okay. So some people have also reduced their production. For example, big players like, there are a lot of big players like Rashmi, Sham and other players. So, what they decided initially was, to run the captive plant and, probably take a little bit of maintenance for the merchant sale plant. So the strategy keeps changing depending on the market. So we'll be wait and watch and see how it unfolds going forward when the monsoons are over.
Okay, got it. Second question on your downstream business. Typically from billets to rounds to galvanized, typically how would the conversion cost change?
See, the operating cost remains more or less the same. It's only on the input side, for example, sponge iron. For sponge iron today, thermal coal prices are at all-time high. So that plays a substantial role in, deciding our operation profit. So depending on sponge prices, billet prices keep moving up and down because, there are other factors like CPC, which is again all-time high, then ferroalloys, then pig iron, scrap. So a lot of factors are there to, decide what the operating cost is going to be. But on an annualized basis, the cost remains plus minus 10% here and there.
No.
If you're able to operate at full capacity.
No. My question is between billets, rounds, and galvanized, right?
Yeah.
I mean, typically, how would the cost structure for you change between billets to rounds and rounds to galvanized, right?
See, galvanized, we are not using the captive material, for your information. Galvanized plant is using the material and the plate, etc., is bought from the market, converted into galvanized product and whatever shape and size it is required, fabrication shop, and then exported. We are working on a steel melting capacity in order to feed the galvanized price, and therefore we have said that this expansion of the steel billet from 0.4 to 0.6 we have kept in hold because we are working on the technology and the size of the unit which we can set up so that the fabrication unit itself become part of your value chain. Otherwise, the fabrication business today, they are buying structural from the market or plates from the market, just converting it to the various requirements, the galvanizing it and selling it in the market. So it is purely a conversion business at this point of time.
Got it.
Yeah.
Yes, thank you. That's it from me. Thank you.
Thank you. Next question is from the line of Aman from Augmenta Research. Please go ahead.
Hi sir. Thanks for the opportunity. So can you throw some light about like what would be the conversion cost from, let's say, per ton of iron ore to the pellet thing? Because as we are seeing that the prices of iron ore are going down, and currently, if you look at the difference between the landed cost and the cost of iron ore in the market, the difference comes out around 5,000 rupees a ton. So can you just highlight about what could be the per ton cost of conversion from iron ore to pellet?
The conversion cost from iron ore to pellet at the moment, see for us, most of the material coming mine for us. So, if prices are going down in the domestic market, it doesn't change our conversion costs, being a captive miner. Currently, with the coal prices hovering all-time high, even the oil towards, all-time high because of crude, currently the conversion cost from iron ore to pellet is about 1,800 rupees a ton, 1800.
Okay, sir. Thank you.
Thank you. Next question is from the line of Kunal from Reliance Securities. Please go ahead.
So just a follow-up question. Are we looking at any inorganic growth? Because we've heard that a lot of EOU units who are exporting pellets have shut down. So are we looking at any inorganic growth?
No. On the pellet side, we have no intention of doing that.
Okay. Thank you.
Because I'll tell you why. Because even for the EOU units, the duty imposed by the government, it is also imposed on those plants as well. So, for example, KICL is shut, although it's an EOU unit, because he has to pay 45% duty for exporting pellets. So does that make sense?
Okay.
Yeah.
Okay. Correct. Thanks.
Thank you. Next question is from the line of Ganesh, individual investor. Please go ahead.
So can you hear me well? Hi, yes, go ahead, sir. So, do we have any constraints on expanding at the current site, at least with the value-added downstream products?
Yeah, we have limitations on account of not land, but primarily because the current area where a plant is situated, it is designed. It has been designated as CPA, which is critically polluted area by Government of India, by Central Pollution Board. So any expansion in this particular plant totally depends on the consumption of energy. So anything related to coal, we will not get permission from the pollution board to install the unit. So there are limitations in this particular premises.
Okay. My next question is, just want to get a sense on why the steel billet expansion was put on hold. So isn't the steel billet capacity a bottleneck for more downstream products like TMT rod, etc.? No. We have kept it hold because we want to make different products, which can be fed into our fabrication shop. And for that, we are working on the module. What kind of capacity will be suitable, how much it can be done, and our galvanized, we can feed our galvanized, and that is better. For that, we have kept it on hold. Otherwise, we can always increase the capacity in 3 months' time, from 4 to 6.
Got it. So it is temporary got on hold. We will expand the capacity going forward. Got it.
Thank you. Request to all participants, please restrict to one question per participant. Next question is from the line of Adya Shah, individual investor. Please go ahead.
Yeah, good afternoon, sir. Am I audible?
Yeah.
Yeah. So just wanted to understand, sir, compared to Q4 FY22 and in Q1 FY23, how has the EBITDA per ton for pellet moved?
No, we don't have the number ready at the because we don't know, per ton.
But sir, would it be correct to say that entire dip in basically in NSR, the dip that we saw, 3,000 rupees is the dip in the NSR in pellet. That would be the dip that we have seen at EBITDA per ton level, or there is some volume impact also?
No, volume impact is not that the volume was higher than what it was in the Q4. So far as conversion cost, Abhishek has already mentioned in the call, is 1,800 rupees a ton. So 1,800 rupees a ton plus cost of iron ore. This is what the cost of the pellet is.
Okay. So my second question is on thermal coal. So, do we have the numbers, sir? What was the average thermal coal cost for Q1 FY23, and how do we see that going for the rest of FY23 standing today? I know it's governed by a lot of other global things happening in the commodity market, but sitting today, if I were to ask you, what's your sense on the prices?
So Q1, the Q1 average pricing for Potash sponge iron was about 14,500 rupees a ton. And in Q2, it will be somewhere about 15,500 rupees a ton. So a marginal increase. So we are able to maintain at the same level because of advanced buying.
Okay. Sir, I was asking about thermal coal, sir.
I mentioned thermal coal only. So thermal coal, which we are using for sponge iron, the landing cost to the plant is about, say, 70,000 rupees a ton. 70,000 in Q1, and in Q2 it will be somewhere about 90,000 rupees a ton. 19,000.
Okay. Understood. Yeah. Okay, that's all, sir.
Thank you.
Thank you. Next question is from the line of Nilesh Gandhi from Meta Design. Please go ahead.
Hi. No, all my questions have been answered. Thank you so much. Congratulations to the team.
Thank you.
Thank you.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yes, so can you just give a brief sense of what would be your current cost of pellet production basis whatever the increase you see in all the costs?
Cost of pellet production is 100 rupees a ton. No, we have just discussed this point. Conversion cost.
1800.
So totally around 5,000, including iron will be around 5,000 rupees, including all the cost, all taxes.
No, so at the moment it will keep varying between, say, 5,500 plus minus 10%, because of the coal we use for gasifier, or have to use oil because of availability and other additives like bentonite. So everything, all the cost has gone up. So I would say 5,500 plus minus 10% would be a basic number.
Sure. And do you expect any reduction in terms of the cost of production going forward? Because you mentioned regarding some royalty that you have to pay will probably.
Yes. So going forward, with iron prices going down domestically, we expect a reduction in royalty about 2 to 300 rupees a ton. So that will straight away add to our cost going on the lower side. And second would be once the monsoons are over and the availability of coal becomes better, we should be able to reduce our operating costs as well by 200 rupees. So overall, I see 4 to 500 saving going forward. Which is about 10% of our current production cost.
Sure. And in terms of mining also, sir, as we ramp up the production, do we get any cost benefits, or this is even at 3150 the cost of mining?
No, see, as I mentioned earlier, the 3150, the average cost should be about 2,700 rupees, but account of royalty and the diesel escalation, the cost is as much as 750. Once the operations are further ramped up, I don't see a substantial saving. Probably 100, 150 rupees here and there. It is not very big.
So we should not assume that 5,000 is more or less going to be like the base cost of production for pellet for us, accordingly.
Yeah, as I said, 5,500 plus 10%, it should be a realistic figure. Because 500 rupees here and there, it's not a big number. The coal is not there, the oil prices go up, or anything else goes up. So all depends.
Okay, got it. Thank you.
Thank you.
Thank you. Next question is from the line of Ganesh, individual investor. Please go ahead.
Yeah. So the coking coal price last quarter it was around 400 plus odd. Now it is 200 plus odd. Does it affect our pellet premiums?
Sir, to be honest, since you're out of the export market, and domestically, I do agree at a certain amount of time it does impact the pellet premium on the high grade. But with the current scenario, we think the more players start buying premium products, they will realize the actual value of it. So I'm confident it will not impact to a very great extent. We should be able to get the desired premium going forward.
Got it. Just one more question.
What has happened in India is, because of low ability of high grade iron ore, which is about 63 earlier, now everybody in India is making a pellet of 62, 62.5. That is the benchmark in India now for pellet makers. So when the Fe goes down, your gangue content goes up in your pellet. So that will increase the slag volume and the coking coal cost for the blast furnaces. So I'm confident with our premium products, we should be able to get the better realization, maintain the same premium which we were getting earlier as well in the export market.
Got it. Just one curiosity question. So compared to your nearby peers, Godawari's ferroalloys volume seems to be very low. So any reason we have not scaled that portion of our products up?
Sorry, which one? Ferroalloys?
No, I think we are our current capacity, what we have, I think we're operating close to 95% of capacity.
Okay.
What is the question, please?
Yeah, my question is, any reason why we are not scaled the volume up in that area?
No,
Ferroalloys.
Yeah,
I would. So I think no. So our current capacity of ferroalloys at Godawari, which is about 16,500 on annual basis. So we produce about 4,000 tons in Q1, which is in line with the capacity. Then Hira ferroalloy, the capacity is about
60,000 tons is the capacity. Operating at at about 45,000 tons, so 75-80%.
Yeah. So so what we're doing now is, see, right now thermal coal is a big issue, right? So operating plants which are coal based becomes difficult and challenging. So depending on the current market scenario, we keep changing the charge mix, because of which the production keeps varying. For example, if we make ferromanganese, the production volume goes up. But if you're making silicomanganese, the production volume goes down because of power consumption. So depending on the market realization, we keep changing charge mix.
Got it. So my original question was, even our rated capacity is pretty low compared to some peers.
So you are right, because we have not done expansion in the ferroalloys business. But if you do a ferroalloys business expansion, then you need to have a long-term energy requirement, and the power of thermal power plant. So that is the reason we have not expanded. Because if you want to put up one furnace, then you have to put up a machine capacity of your power plant as well. And you have seen, if you see right from 2011, 12, 13 onwards, but between 2011 and 13, we committed substantial amount of capex in building, solar thermal power plant, increasing the pellet capacity, and we wanted to expand on this side of capex, but because of the fall in the commodity market, those plans were kept on hold. And with the improvement started from 2017-18 onwards, we have been debottlenecking wherever is possible and doing that. So similarly, we are working on Hira ferroalloys in debottlenecking, improving the capacity up to 60,000, which is current production is 45,000 tons, and that we will be achieving by another 8 or 9 months. So greenfield project, again, there is a land requirement and other issues are there. We have not thought about it earlier that we will expand the capacity in ferroalloys in a greenfield location. And Raipur market being, it's not close to the port, so transportation cost is very high. If you have to, import the manganese, and if you have to sell the, finished product in the international market. So as and when this expansion takes place, will be taking place closer to the port area. There, you can save on the logistics cost.
Thank you. Ladies and gentlemen, we'll move to the next question. The last question is from the line of Kunal from Reliance Securities. Please go ahead.
Sir, during the last call, you had mentioned that for domestic players to use our high-grade pellets, you will require coking coal prices to remain high. Now that coking coal prices are expected to, come down significantly in the second half of the current fiscal, what's your view, sir?
See, as I said earlier also, I am confident because of the overall pellet quality in the domestic market going down from 63 to 62. So, and our pellet being still 65 plus. So I am very hopeful we will still get the same premiums which were desired in the export market. I don't see an impact happening on that side.
Okay.
Because eventually people have to compare the absolute numbers, versus the other raw materials available compared to our pellets. So at the moment we are getting a desired premium, and I'm confident we will be able to continue to do so in the near future as well.
Okay. Thank you, sir.
Thank you.
Thank you very much. Ladies and gentlemen, due to time constraint, we close the call. I now hand the conference over to the management for closing comments.
Thank you, ladies and gentlemen, for joining the conference call to discuss the Q1 FY23 numbers of Godawari Power and Ispat Limited. We have been able to. I hope we have been able to answer to your satisfaction. If you need any future clarification, you can always get back to us or our investor relations agency, Go India Advisor. Thank you very much.
Thank you very much.
Call again later.
Thank you very much. On behalf of Go India Advisors, that concludes this conference. Thank you for joining us. You may now disconnect your lines.